All right, guys, just another moment and we will get started. All right, thanks everybody for sharing your morning with me today to talk about our second part of the trend following signals and options webinar. Where today we want to talk about implementing a hedging strategy because that's as important as anything when we're dealing with a trend following system that is leveraged with options. Once again, I'm Keith Harwood, and this is an option hotline presentation where research meets strategy. As always, we're going to start with those disclosures before we get into the real content here for you guys. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Again, my lawyers really want me to make sure you guys read through this, so I'll give you guys a moment to do so. All right, let's get back into it. So remember what we've been talking about, this 90-day window of negotiation between the United States and China. We are walking a tightrope. Fear and greed are going to alternate in this environment while we watch for what new trends will form. So this is that opportunity. We're getting in at the beginning of new trends as the fundamentals change and using technical signals to tell us which stocks are going to be the benefactors of this shift in macro policy. This is an opportunity that we just don't see. Okay, so you see opportunities come like this every decade. You know, the subprime crisis led to major opportunities coming out of it. The internet bubble, the burst, and then the recovery, that created amazing opportunities. This is creating another round of amazing opportunities because we're getting a pullback in the markets where things that shouldn't get sold are being sold. And then stocks that are going to take advantage of this shift in policy are going to start leading and generating really, really well-timed entries for these long-term trend profits. So what's been going on this last week? Well, first off, we had a truce over the weekend. Everybody's all smiles. This is great. The market is going up and there's nothing that can stop it except for the fact that this is going to take 90 days. But oh, well, that's fine. We'll figure it out. And then 48 hours later, Huawei's CFO arrested at U.S. request, sparking outrage in China. What? We find out that it turns out that there's fear still priced in. We've still got a long ways to go to figure this out. It's not all shiny, happy moments yet. And that's why with big league options, we like the hedge. So when we're going through scenarios like this, where there is fear in the market and greed instead of just this drift higher like we saw last year, 2017 was easy. You just go long and you make money. This year, there's chop. There's circumstances that just create these big pockets of concern. February, we were talking about the rise of interest rates potentially creating a situation where markets needed to pull back because allocation models were going to start going into bonds. And so we had that crash in February. We recovered. That created opportunity. This opportunity is even bigger because it's built upon a big fundamental shift as opposed to off of a nuance in trading. This is a shift in macro global economics, creating opportunities that will not be there for long. So that's why we need to get involved now with this, because the time is now. This is an opportunity. I've been trading for 13 years. I haven't seen many opportunities like this, frankly, in the 13 years that I've been doing this, okay? So what we look for is these opportunities to generate explosive returns by following a trend in the names that are stronger than their index. And then with a hedge, we protect and accelerate those gains. So that instead of being flat, and actually NASDAQ is now down on the year, we've got positive returns and really positive returns with a hedge. So a reminder to those of you that were not able to attend yesterday, and you're going to get the recording as a reminder. And another reminder here, if you guys have questions, feel free to throw them into the Q&A, and I will get to them either during the presentation or at the very end. But a reminder of me, I'm Keith Harwood. I started on the floor of the CBOE, and that's where I really learned everything about the nuance of options that I've got, that I utilize in my day-to-day trading. I traded as a volatility trader, not a directional trader. My goal was to capitalize on shifts in volatility. And I knew that as volatility started to come back down after the subprime crisis, it was going to become a little bit less of an opportunity to trade volatility in that way. Markets were tightening. It was becoming more clear that maybe the better play was to be able to combine multiple edges because volatility movements were coming down. Instead of having large ranges in volatility, they were starting to tighten up. So how do I have to make my money? Then I have to find a second edge. And so my second edge is this directional edge. I use technical analysis, a lot of which was accelerated from my time getting my MBA at the University of Chicago, and then at a CTA, which is a commodities-based hedge fund, where I learned a lot about technical signals. I learned a lot about trends, and then I learned how to implement my options knowledge into those systems to generate leverage and define risk. And then that's why I started Trade Academy and partnered up with Option Hotline to bring these products. So yesterday we talked a lot about the trends. We talked about the signals. And today we're just going to cover two main things: hedging the portfolio and then the current market setup, because this is huge. This is huge. And this is huge. These are big, big topics that need to be understood. And then we'll get into that special offer at the end that I presented to you guys as well yesterday. First off, we're going to do a little reminder of that risk management. So the first step is those stop losses, right? So we use stop losses to tell me when the trend is no longer intact and stop me from sitting in a bad trade. So a trade can be really good for a long period of time. It could be months, could be years. But then at some point, just that stock is fully valued or overvalued and people start moving out of it. Think of what's been going on in big cap tech recently. Those FANG names that everybody was so hyped up on for years. Well, guess what? Now they are getting rolled over because a lot of people said, even while they were rallying, that maybe they're a little bit fundamentally overvalued, but you got to stick with the trend. Well, people are pricing in the fact that they may have been a little bit fundamentally overvalued. So we got to get out of those and look for those trades that are undervalued and can capitalize on what's going on with the US-China trade discussion. So we use those stop losses to get out of those bad trades, recapitalize our portfolio, have cash to use to maneuver into those new stocks. And then as we're using these trend following systems, as the price goes higher, we're raising the stop loss. That's the trailing stop element. And that's what prevents us from having a stock that we're in from a very, very low price and then never able to sell. We have to have a sell point on a pullback. And that's what we use these trailing stops for. Because with the trend following system, yes, we want to ride that trend. And then because we don't necessarily want to exit, even if it's at highs, because we saw yesterday in some of those examples. I mean, Illumina, it just kept going, even though it looked really high. Netflix, it just kept going, obviously, before a pullback. Because these stocks, oftentimes, they just get this momentum behind them and they just don't want to stop. So I don't want to exit the stock and then see it go up another 50% and say, gosh, why did I do that? I want to wait for the momentum to turn, for the tide to turn, for the chop to come in to tell me, you know what, maybe this isn't time to be there. But that's why I'm raising that level on my stop, especially when I'm using options, which have that leverage. Otherwise, as we said yesterday, the risk to holding the position increases when the stock's going higher because we're further from our stop. All right. And that's what helps generate the returns here. So today's focus, again, is going to be on hedging the portfolio and how to make sure we're protecting those assets. Because when we have these stocks run really strongly, like they did from May really through the end of September, before the collapse in October, it's hard not to want to stick around. And so then we look for the hedge when stocks are at highs rather than an exit. And that's what I'm talking about here, is hedging the portfolio when stocks are at these highs, as well as when they're coming back down. There are two times that we hedge. So the first element is to make sure that we have a way to hedge efficiently because we're highly leveraged. Okay, so we don't want to just sit in a highly leveraged portfolio and have October happen and never exit. So if we're not exiting with trailing stops and we're not hedging, we're just exposing ourselves to adverse moves. Sorry, there we go. So when we use the basket of stocks that are all in one sector, we hedge with QQQ ETF by calculating the beta weighted risk of the portfolio. This calculation is explained when you sign up for the program. There's a whole course that I put together on it because it's a bit complicated, it's a bit nuanced, and I really just don't have the time to go through this in detail right now in such a way that's going to generate, a benefit to you guys. But I get granular there so you guys can really understand it and make sure that you understand where you're going with this stuff. Okay. So that way, when February of 2018 or October of 2018 occurs, we can preserve capital, increase cash instead of just losing money, and do it in a really efficient way because the QQQ ETF is always going to have greater liquidity than any individual name. If I have a position in Microsoft, it's generally going to be very liquid. If I have a position in Apple, it's going to be very liquid. There are times when Tesla options get incredibly illiquid, or, Starbucks even, or O'Reilly Automotive, or any of these names where they can get some big movement and big benefit when they're going right. But then when something starts to change in the market and the whole market starts to collapse, liquidity can dry up very rapidly. This is something that I was well aware of as a market maker on the floor. When liquidity dries up, that is an excellent time for the market maker because people that panic into those individual names and make a bad trade really are just stuffing the pockets of the market makers down on the floor. And I don't want to do that. I want to protect my portfolio and protect my cash balance instead of paying somebody else for a trade that's going wrong. And this is what we did in October for Big League. When we saw that September 28th peak and we saw overbought conditions and we saw all these stocks going up, we had we had one hedge and we rolled out of it as we took trailing stops off. So remember, we had trailing stops. And so that means that as we got towards the end of October, we're exiting some of our other positions, but capitalizing with our hedge. And then when we get to the end of October, we're capitalizing again with our hedge and rolling into a new position because we've had such a big move in the market that our puts exploded. So on a $50,000 portfolio, we had close to $20,000 of hedging cash back in the portfolio. That positions us to go to the next level of buying, finding the next opportunities. And so there are two key times to hedge. Each of them requires a different style of hedge. The first one is simple. It's the drawdown. This is the one that we don't like, but that's there to stop the bleeding. Why do we not like this? It's because we're probably losing money during this environment, but we need to stop that loss because if the market does continue to collapse and you have something like the subprime crisis where markets just absolutely tanked, the hedge all of a sudden flips from stopping the bleeding to generating returns. Why does it generate returns? Well, because we're taking losses on our other positions or locking in profits if we've been holding them for a long time. And then we're using these 50 delta options that are increasing in delta. Again, for those of you that aren't familiar with delta, it's all described in the program. But delta is basically an at the money put. So if a stock is $200, we're looking at a $200 put. Stuff like that is again explained more in the course. And we use the Qs for efficiency because we're trading NASDAQ 100 stocks and everything has a correlation to NASDAQ if it's part of the basket. Okay, so what we're doing here is stopping the bleeding and possibly generating potential for increased returns if the market really falls. What we would love to see in this scenario is the market to bounce back because we're hedging, and generally our preference is for the hedge to lose, but we also want to position ourselves so that that hedge can help build cash in an adverse move. And because we're using leverage, the hedge can oftentimes do just that. All right. And the other time to do this is speculatively. So when I say speculative, I'm saying all these stocks are at highs. The whole market looks overbought and it's getting too crazy. But our system tells us that not only are the stocks that we are in likely to continue to trend long-term, they're also probably going to be the ones that outperform the index. Why is that? Because these are the best names. These are the good ones. These are the ones that everybody wants to own and can continue to own for maybe years. the stuff that we're going to start finding as we go through this US-China trade debate. Those are the names that are going to be worth being in for a long time. We got to get in at the right price in order to generate the returns. And so as long as we're in them, we do want to hedge because we want to protect the capital. It's about protecting what we've made and reducing the drawdown potential. So if the market starts to fall, these speculative puts appreciate in value, but they are generally cheaper. They are farther out of the money. They are not as close to the current price because we want something that's a little cheaper and a little bit more leveraged in case the market just continues to go up or spikes down. Okay, so the speculative hedge is a little bit of a different function. Again, I describe all of this much more granularly in the course that I put in with the program. All right, so how do we do it? What is the actual implementation of this hedge? We go through a process. Everything requires just a process of sort of following a checklist. Okay, so we just calculate the risk of every position and the beta relative to the Qs. We then move forward and we calculate the total risk of the portfolio. So we now know what our market risk is. We know that we have a bunch of individual names. Maybe it's 10 of them, maybe it's 15, 20, 25. But what we want to know is in terms of the index pulling back, if the index collapses, what is our exposure? And that's what we're calculating here as a total risk. And then we say, all right, where's the market technical setup? What's our performance? What are the metrics telling us? Are we in a drawdown? Are we in an overbought situation? Are we simply grinding higher and don't even need that hedge? Generally speaking, if we're going through the process, it's because we think that we're at a point where we need to have a hedge. So that market technical setup is telling us we're overbought and we need to protect these assets. So what do? We go through that whole process. We scan the market for the best portfolio hedge, and then we size it appropriately. This is all very thought out, very precisely executed, considered to make sure that what we are doing best protects our portfolio. Because we have leverage to the upside. We've seen that. We need to have leverage to the downside in case of a collapse. And then we're going to look at these charts here to talk now that we've talked a little bit about the scenarios here. I want to go through the charts and talk to you guys about what's going on now in this environment. What are we seeing in the markets and why we need to be able to hedge and at the same time jump into these opportunities that are just starting to appear. And it looks like we do have some questions here before I get into the chart. So I know a couple of you guys, it's your Sunday morning, got to get off and get back to the family. So it looks like some people were wondering about the sign-up process for Big League after reviewing everything yesterday and going through it again today. So a reminder of how you do this. It's very simple. I want you to go to optionhotline.com/subscribe. I'm sorry, the E got cut off there, but there's an E at the end. Subscribe, full word, optionhotline.com/subscribe. We're talking about big league options today, and you're going to click join options program. And then you're going to go to the sign up page and type in holiday 2018 to get half off. I don't normally do discounts like this, but I know that you guys are all serious investors looking for amazing opportunities and that you're going to tell your friends just how much value I've added to your trading. And then that's where it makes a difference for me. And then once you do that, this is what you're going to get. A reminder. We've got those weekly trade ideas. A lot more trade ideas right now because of everything going on in the world. When the market's grinding higher, it's mostly just about managing positions and maintaining profits. But when the market is going crazy like it is right now, we're getting new ideas. We're rotating our positions constantly. We cover the NASDAQ 100 options. We give you portfolio tracking so you can monitor performance. You get the trend trading course so you get the understanding of where this really comes from in fine detail. It's a multi-part course that covers all of the information you're going to need to understand how our portfolio builds. We do a weekly newsletter talking about the macro environment. We do webinars. You get email trade alerts so that you know when we're entering, exiting, rolling, or hedging. You can get them in real time with a text alert so you never miss an alert. And of course, the stuff we're talking about today, the fine, detailed hedging course and the hedging activity report so you know how we are looking to hedge our model portfolio and why. Okay, so all of that is included for $14.99 a year. And because I'm feeling generous and it's holiday season, you can get any of the programs that we cover for that same half off if you use that promo code. So our home run swing options, which is looking for really fast, quick moves, that's half off. If you're looking for commodity exposure, trading commodities, much better than investing. I can tell you that from years of experience. That's half off. Big league stocks is included in big league options, but you get that half off if you want that independently. All right, guys. Now with that in mind, let's go to some charts. So let's see here. I got to show this taskbar here for it. This is what I've been kind of preparing. I want to talk to you guys a little bit about some of the recent entries we've been talking about and show you guys a little bit more about why we find that these trends matter, that these outperforming stocks are still worth owning, and how we can hedge at the same time. So this is the real market setup as of Friday. Tesla doesn't look like it's had much of a trend this year, right? It's been a choppy trade, but our system is starting to tell us that things are shifting. Let's talk about some of the stuff that we talked about yesterday. What are we seeing in the moving averages? Okay, yeah, I see a couple of you saying, yeah, we're above all of them. Yep, that's good. Here's this. The 50-day is above the 100, is above the 200, and the 10 is above the 20. All these moving averages are starting to stack up where the shorter term trader is seeing more profits than the longer term trader. That's giving us some signals. Everybody, every time frame has a bullish signal to it. And we're seeing moving averages going the right way. We're not overbought on the RSI. The MACD is fairly neutral on momentum because of the chop of the market. So this is a trade that we actually looked at about last week on December 4th. Okay, so I admit we are down very small on this trade, a couple percent, because the market has been collapsing. That's why we hedge when we put on these trades, right? So our hedge that we implemented at the same time is up 77%. That's why we hedge when the market is not also showing signals of a trend higher. So Tesla is setting up to be one of those outperformers. It's one of those amazing opportunities. It's one of those trades that we're just getting into because it's just starting to show its relative strength and what it can do as we resolve these issues with the United States and China. Excuse me. So this is one that had been asked about yesterday. Are we looking to stay in this position? Absolutely. But if it doesn't work, we're going to apply our stop loss, right? So we're in these calls right now. If the market starts to pull back in Tesla, it tells me that either the whole market is collapsing and my hedge is doing great, or Tesla wasn't the big winner everybody thought it was going to be. Now they're realizing it's not. I think it is. I think it's going to be a great performer. That's why we're in it. But I have my hedge, I have my stop, I have all of this set up so that this thing can work and generate explosive returns. Another one that we entered just about 2 weeks ago is Henry Schein. So you can see again, yeah, pulled back a little on Friday because everything was getting sold on Friday. Tuesday, Thursday, Friday got a little bit of a pullback. But look at this trend. I mean, if we look for this year, this has been trending higher with a little bit of chop. And one of the things you'll note is that it is still above the 200-day moving average, still above the 100-day moving average, and just a small retest of the 50-day moving average. That's not a major problem yet. Still looks really strong. Looks to me like this is a stock that got hit a little bit because of its market beta exposure. Because this is what's going on in the Qs. This is why the hedge matters. This is where that leverage comes from a hedge. Down 3.3% on Friday. That is a big drop for an index, especially following what we had seen on Tuesday. So while we're entering these other trades, we're hedging. So our most recent hedge was entered on November 29th. There you go. That red bar day. With the Qs around 168. So the Qs have dropped $7. What is that, about 4%? While the individual names that we were adding are effectively unchanged. down very small, less than 1%, maybe 2% kind of moves, or flat. Our Henry Schein is dead flat from entry. And we're hedging this by selling that basket of stocks that's not going to do well, or that people just say that they can't be part of it. So because the Qs own Henry Schein, they own Tesla, they own Apple, they own Amazon, they own Netflix. So all these other names that maybe don't benefit from anything going on with the US and China, or just need to be sold, we're effectively short those by having this hedge on. And then our hedge is now in the money puts. So these were built off of more of a speculative hedge setup. I'm glad we have it. These puts are up 77% in a week. We entered them on November 29th, and they're up 77%. That is the benefit of the hedge, because that allows us to look for ways to roll and recapitalize our hedge, take some cash off the table, or build out new positions, because the delta of these options has increased. So we have more short exposure, hedging off our long exposure, allowing us to add new positions. This hedge is so powerful for us for that reason. And I'm going to give you another one that's going on right now that has been a great move all year. And it went down 3.5% on Friday because the market is just trying to sell some stuff out. But it looks really good relative to the NASDAQ. Why? It's well above the 200-day moving average. It's just at that 100-day moving average. There's been some chop, some consolidation. But if the market flow starts to go positive, this should benefit drastically. It's Costco. We've been in since May 2nd. Sorry, May 1st. We've been in since May 1st when the stock was trading $197. What does that mean? That means we've rolled our position. We rolled it in August. We're up 102% on this position. We were hedging it on September 28th when we were hedging our whole portfolio. So with the market collapsing, Costco came down a little bit. With the market collapsing, Costco comes down a little bit. What does that tell you about Costco? It tells you that it's a pretty darn good stock when it cannot ever seem to find a way to liquidate. These small pullbacks, and yeah, 3.5% in one day is a large pullback relative to a one-day move, but over the course of time here, this has not fallen at all. It tells me that there are buyers out there, that there are people excited about the story, and that's what we're looking for, is those exciting stories. And again, when the market is telling us we can't just simply sit and watch it move our way the way that we could even back in May of this year when the market was just grinding higher. Right now, we've got some negative signals, a lot of them. So we hedge. The hedging protocol is a big difference maker. I know a lot of you have seen some of these other programs. They ignore a hedge. They skip the hedge. They just use stop losses. That generates worse performance. If we can use a hedge while using leverage, we can generate explosive performance. And so that's what we've been talking about for the last 2 days, is planting these seeds to becoming a winning trader. How can I help you learn and grow in your trading career? Well, the first step, as we've talked about, is signing up for Big League Options. And this is a reminder of the special deal we're offering just through the holidays. Again, there is an E at the end of this right here. That's a typo. We'll put that E in there for you. This is optionhotline.com/subscribe. And you type in, click here on the Join Options program for Big League Options, and you type in Holiday 2018 to save 50%. Gets it down to $14.99 a year. It's an offer that we're only providing this one time during the holidays, during this opportunity, because the time is now to get people in. And I expect that the amazing information that you guys receive here is going to lead to you guys wanting to tell all your friends about this program. And that's where I can benefit. If I can get you guys to take a look and just understand the value that we're adding, I know that my programs are going to explode via word of mouth. And that's the benefit I get by offering you this special discount during this opportunity. So again, you get these weekly trade ideas. And as I said, there's a lot more right now because of the market setup. It's all on NASDAQ options. We provide the portfolio tracking so you can see the performance. You get the trend trading course that explains the nuts and bolts of everything here. We've got that weekly newsletter, webinars, emailing you all of your trade alerts, giving you real-time text alerts right to your phone so you never miss an update. The hedging course that gets much more granular than what we've done today. The hedging activity report that tells you all about how we're hedging. I told you guys that we have those hedges on right now. They're up 77% in the week. We explain those via the hedging activity report and why in the hedging course. Now, with all that in mind, I want to make sure you guys understand what you're really getting here from me, okay? So I'm going to promise you guys that you're going to get a level of service that you really, really appreciate and enjoy. I'm going to devote my time and energy to making sure you guys become better traders, understand the markets better. This is all about that education. I want you all to succeed. And so I can promise you that I will give you that level of service that you need in order to help yourself become a better trader. And I'm going to give you access to me whenever you need. So if you have a question, you can get a hold of me. I've talked to a lot of people that say that, if they've had programs before that aren't working, that they can't get a hold of anybody, or they are working, but they have a question. They can't get a hold of anybody. That takes days or weeks, or they never get a response. I am always on. So I'm always looking to answer your questions and make sure that we don't have that communication gap. And in return for what I'm providing to you, I just ask that when you look at this program in a couple of months and you realize just how much value it's added to you, that you tell a couple of friends. Then they sign up. They get the same value that you did, that you're getting. And I get that benefit of helping grow this community of investing professionals into being the best community on or off Wall Street. All right. So I know we had some questions that were coming in during. And if there's any others that the people have, feel free to type those into the Q&A box or the chat box now, and I will address them for you. All right, Joey, did you have any others that you saw coming in?
Looks like we're good for today. Great job, Keith.
All right. Thank you, guys. So it looks like we are covered on the questions. Oh, actually, sorry. I did just see one pop in as well that just came in. So there was a question here about if they buy multiple packages, if there's any discount. Obviously, we're already giving you 50% off any of these packages. We have a package called the Grand Slam Bundle. It's big league options plus home run swing. So that right now, if you bought it with the two packages, it's basically $24.98 a year. I'll take another 10% off. So you can get it for $22.49. Okay. So if you want to buy these two together, you save another 10% for the year. And I think that gives you guys that much more opportunity here. So this is all about the long-term trends, and this is about short-term trading opportunities. So take a look at that as well. And again, go to optionhotline.com/subscribe, big league options, join the options program, and don't forget your promo code. All right, folks, thanks again for taking time out of your Sunday and yesterday on your Saturday. And I look forward to working with you guys in the future.